Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, we're going to take a look at AT&T, and we're going to look at AT&T post-spinoff of the Warner Media entity. They've spun it off and given it to Discovery. That's now Warner Brothers Discovery business. And we have AT&T was a net pure play on the wireless communication business that the new CEO is going to double down and grow it and be a major competitor to Verizon. Let's take a look and see what this business looks like post-spinoff. I'll explain the reverse merger that took place. We'll look at what the entity that's left and what kind of cash flow that business is going to generate out 10 years and see how much money we can make if we bought AT&T stock today. Ready? Let's get to work. All right, what we're going to do today is we're going to review the financials for AT&T post-spinoff, take a look at what they're projecting for the business, and figure out how much we think this business is worth. Now, what we're going to do is we're going to use our 5 key attributes like we always do to evaluate AT&T as the pure play wireless technology company that they are now. Number 1, top line revenue growth. Number 2, earnings growth. We use EBITDA, enterprise level earnings. Number 3, strong free cash flow, a must. Number 4, low debt, less than 3 times debt to EBITDA. Number 5, well priced. We want a well priced stock. Well, how do you define well priced? For us, I want a stock that if I build a conservative growth forecast, I have a high probability of outperforming the market. That's the idea behind a well-priced stock. This is all a guessing game. Who knows what's going to happen in the future, but what we want to try to do is build a portfolio of maybe 20 to 30 stocks. Each of them on their own, by the time you buy it, has a high probability of long-term beating the market. That's the best we can do, and that's what we try to achieve here in this channel. Now, behind me is the report that was published to explain the spin-out and merger. And what I want to do is I want to cover quickly just the structure, and then we'll go through the financials, and then we'll look at the forecast. So the structure of the merger is here. You had AT&T shareholders, and AT&T is much, much bigger than Discovery. And what happened is AT&T kicked out the Warner Media business into a new company, and Discovery contributed all their assets into that new company. And the AT&T shareholders own 71% of this business, and it came with debt and cash to AT&T. Debt went this way, cash went this way to AT&T shareholders. So now we're here. We're in a post-spinoff world. There's a large cash balance on AT&T's balance sheet. They're pledging to pay down debt. They're just a pure play wireless technology company. So let's take a look at what they're forecasting for earnings, what they've done historically when we adjust the financials for the carve out of the Warner Media division, and let's figure out how much cash money they make. All right, let's go to the 10K. So behind me is the balance sheet for the adjusted business. This is AT&T as of December 31st, 2021, and what they're doing is they're adjusting for the carve-out of Warner Media. Here's the historical numbers that they reported in previous financials. This is the Warner Media business that they're kicking out, that they're spinning out, and this is the net result. And here's some transaction adjustments accounting for the purchase and sale of the reverse merger. So what you do is you take your historical numbers, you carve out a balance sheet that you're starting with post-spin-out, and then you account for the transaction in which they received shares, a lot of shares in NewCo, and some cash, $39 billion. And what you're left with is a pro forma business that's got $58 billion of cash on the balance sheet. Let's scroll down here. $58 billion of cash on the balance sheet, $470 billion of total assets, most of which here is these 2 lines here, property, plant, equipment, and net lease expenses, and a good chunk of goodwill. And then in terms of debt, they've got $150 billion of long-term debt, some short-term, and some pension liability of $12 billion. Also some leasing obligations, about $200 billion of total debt. And this just breaks out how much debt, assets, and so forth are kicked into the NewCo, into the Warner Brothers Discovery business, and how much of the assets, liabilities, and so forth that AT&T is retaining. Let's go take a look at the income statement. Okay, here's the income statement behind me. This is 12 months ending December 31st, 2021. They did this same thing for 2020 and 2019. I'm not going to cover all of those. I'm going to consolidate them for you quickly, but I want to show you how they lay out in operations. Historical AT&T combined, The discontinued operations is basically the carve out of Warner Media. The ongoing business, continuing operation, which is the classic core AT&T business. What we're looking at, they've got other cash inflows and outflows from transaction costs, and they have some final adjustments of the M&A deal itself, giving you a pro forma going forward. And in 2021, AT&T, pure play AT&T, made $118 billion of cash. That's a lot of jack, by the way. The OG subscription business is cell phone service, by the way. And they have various costs with a $22 billion, I think that's right, operating income, $22 billion of operating income. And what we're going to do to come up with the depreciation is I'm going to start with operating income. I'll add back depreciation and amortization, which is here. And you can see they've excluded it from all the other costs. I should say right there. Yeah, cost of revenue exclusive of depreciation. So this is basically pure P&L costs. You've got depreciation and amortization of $17 billion. Add 22, that's going to give us roughly our EBITDA that we're going to use. I will note that interest expense, right, is below operating income, so that's why you can start here because it doesn't have interest expense in it. And one thing that boosts AT&T's earnings per share, if you look at earnings per share, is this $12 billion. This $12 billion is not actual cash. It is an accounting accrual for changes in the pension liability based on the discount rate of the age population, the return on the portfolio, whatnot. But it has nothing to do with the performance of the business itself that you're buying. So when you look at EPS, earnings per share, it's net income, right, divided by shares outstanding. That includes $12 billion of fake earnings. Realistically, it's an adjustment to the pension liability that they own. It's not actually the $22 billion of operating profit that they generate as a business. So I think that's why I generally like using EBITDA. It's higher up on the P&L, and it's before income or costs such as these items that aren't germane to the business itself, what we're buying. That's why we use EBITDA at this. But basically, kind of a pure play business, shows you the breakout. And then down at the bottom, it gives you the shares outstanding. These shares did not change for AT&T, the same shares, but it does change dramatically for the new co of Warner Brothers Discovery. They got massively diluted in order to afford the deal. That's how they financed it through equity. But let's take a look at this in our normal spreadsheet and see what we get. Okay, let's take a look at AT&T. Now, this is going to be a little wonky because they don't restate a full 9 years of historical financials. So what I'm doing here is I'm pulling the data I can find up through here, 2013 to 2018, as reported by AT&T, and that includes the merger that happened in 2018 when they bought Time Warner to begin with. That's where you can see this $10 billion step up. And then what I'm doing is I've restated the numbers that they've presented to us that I just went through. This line I'm here, $118 billion. They also gave us previous 3 years of financials. So I'm just taking a look at this zone here as a pure play AT&T. And you can see why they wanted to spin this thing out, because the business itself was struggling a bit, especially with the $118 billion down from almost $150 billion the year before. EBITDA, again, I was just using operating income plus depreciation, kind of really clean. $40 billion of EBITDA, down hard and then up. Not sure what to do with that. Frankly, it's hard to draw a conclusion on 3 years of data, but we're gonna keep moving forward just for the sake of this presentation. We'll get into how to forecast in a bit. The balance sheet, they did not correct the balance sheet for 3 prior years. So what I've done is I've included the $200 billion of debt that they have on the balance sheet. Again, that includes pension liabilities, includes the lease obligations. So it's a heavier debt burden than what the company will tell you. When the company AT&T talks debt, they just mean true long-term debt and current portion of long-term debt. I'm adding pension liabilities and I'm adding operating leases to be a little bit more robust definition of debt. Excess cash, $58 billion, but I'm leaving this constant because I don't have any other data, and I don't want to change it. So it's a bit of a guess. I get you, but you'll see what I'm doing. We're going to average these 3 years in the future when we forecast. That's kind of why I'm doing it this way, because we know they have debt, and it helps normalize the results. I don't know exactly how to explain it. Market cap, share price times shares outstanding. I get an enterprise value, kind of roughly the same range, right? $300 billion, because most of it's tied to this debt right here. Enterprise value EBITDA range, I think this is largely useless because we're restating historical financials. So I'm not really going to go off this at all. Debt ratio, I do want to use because the debt is the same and EBITDA has been adjusted, so I can use that. And what I'm seeing right now is just under 4 times. I think they said that they're targeting 2.5 times in their presentation, which we'll cover later. Their definition of debt excludes operating leases and excludes the pension liabilities, so they can get close to this number for sure. Our number, however, is 4. Still not too high in my book. It's above the 3, but it's not like it's 6 or 10. So I'm willing to give them a pass on that if the value is there on the return. But overall, this is generally where they're positioning themselves. $118 billion, $120 billion of top line revenue, about $40 billion of EBITDA. Let's take a look at free cash flow. Okay, free cash flow. Now, they don't produce an adjusted free cash flow number, so what do? This is going to be my take on their cash flow. Again, totally adjusted. It's just what I want to use to come up with a foundation to forecast going forward. That's why I'm doing these numbers. And what I did is I looked here at the ratio between EBITDA and free cash flow to operations. And EBITDA is roughly 130% higher than free cash flow from operations. So that's about a 30% reduction in cash for things like taxes, interest expense, and things that are between EBITDA and cash flow from operations. So what I did is I took this average, I applied that to the EBITDA that you saw each year, here, and I come up with these numbers, basically dividing this EBITDA by the roughly 130 I get here, and I get this to approximate cash flow from operations. And that, again, is because they did not give me an adjusted number to work with, so I have to do something. So I did that. I then took the average CAPEX that they've spent historically every single year, and I used it here to give me a rough gauge of how much cash CAPEX I expect them to put forth. And they've been putting forth about $21 billion a year going forward, even pre-merger with Time Warner. So I think that that's going to continue. Now, I zeroed out the debt because we adjusted the debt balance sheet already, and the debt itself is roughly in line with where it's going to be in the future. So I just wanted to see what the business looked like if I put aside debt. Again, because when you do a big acquisition like this and you restate the entire balance sheet, you kind of need to put all that the debt financing aside and just look at the cash flow of the business outside the debt, because you have a new capital structure that you're imposing on the business going forward. So historical capital allocation decisions, capital financing decisions aren't necessarily as material. That's why I zeroed this out. So it's not reflecting true cash flow from operation, it's my adjusted number. But basically that means that what I expect them to generate someplace between this, this is really low, 3, probably higher than that. I would say in the $10 to $12 billion a year annual cash flow range. If I put that against the shares outstanding, I get a price per cash flow range of, what average is that? It's not auto-filling anymore. It's about $1.50 per share. In cash flow per share, $20 is what I can buy the share for currently, and I'm ranging in the 7% range, plus or minus, for the free cash flow yield for the business. Now, one thing that I found very interesting is the company itself put out guidance, and their guidance is a free cash flow of $20 billion. Now, let's go review this, and then we'll talk about how to forecast the business. Okay, we're back here at the presentation that both Discovery and Warner Brothers Discovery and AT&T jointly released, which is here. And what we're going to do is we're going to skip through Discovery stuff. We're going to go right to the transaction for the AT&T transaction material. The pure play business, their EBITDA margin. So they're saying revenue will grow low single digits, adjusted EBITDA mid-single digit. That's a margin. Actually, growth rate, mid-single digit EBITDA. I'm not sure I believe that one. Adjusted EPS we don't look at. This is what I want. Targeting dividend payout ratio of 40 to 43%. That's fine. We don't do dividend payout ratio. We look at all cash flow. But what they said here is an anticipated free cash flow of $20 billion. Now, if you follow this little number here, they're saying free cash flow is cash flow from operations less CAPEX. Let's go back. Take a look. So they're saying $20 billion is this. We're getting 16 to 11. They're saying post-deal, they're expecting $20 billion. That's a big move, and frankly, I couldn't get there. So what I was looking at is, again, taking the EBITDA that they gave us, doing a ratio, coming up with roughly free cash flow, how much they put in CAPEX, net the two, I get this range. They're saying it's 20. And I thought it was interesting that they never ever achieved 22 here. In their historical period, they do a massive deal and suddenly they're hitting 20. So I think this is a skeptical number. Let's figure out what we're going to do going forward. They could hit it as upside, but let's see what we want. All right, now let's forecast the business. So EBITDA is what we're going to forecast on, and I've got $41 billion of EBITDA in 2022. That's basically 3% growth off of the 2021 number. If I just go back and link it, remember this is the adjusted financial that they gave us, $40 billion. I'm growing that at 3%. That's how I come up with the $41 billion long-term number. Why 3%? That's kind of what the business grew prior to the acquisition of Time Warner. If I look at Verizon, which is in the same business, they grow at a very, very weak single-digit number. Also, this presentation says revenue is growing at weak single-digit numbers. They said adjusted EBITDA mid-single-digit, but I don't want to give them credit for that just yet. I'm going to grow it long-term at 3% because they're going from 3% to say 5% makes a big difference over the long period of time, and I want to reserve that for my own conservative forecast. So I'll give them 3 and say, hey, you got to hit that for 10 years and make the investment work for me rather than just assuming a higher growth rate and then me paying for a growth rate that might not be achieved. That puts out 10 years, $53 billion long-term target. I'm giving this a 7 times enterprise value exit multiple. That is the same multiple that Verizon trades at. Verizon is a nice pure play comparable that we can use as what the market measures a business on their EBITDA. And that means that long-term, out 10 years, AT&T pure play is a $376 billion enterprise value business. If I pull off the debt, $200 billion, I add back the $58 billion of cash, and I have a $250 billion market cap, $225 billion market cap, divide by the 7.2 billion shares outstanding, and I get a $31.36 price target, $31.36 price target per share for AT&T out a decade. All right, let's take a look at free cash flow. Okay, free cash flow, we need to figure out how much free cash flow this company is going to yield on a go-forward basis. I'm targeting $1.47 per share for next year, and I get this by averaging the last 3 years free cash flow per share. If we come back to our model and I show you these numbers, that average is $1.47 per share. Now the company itself is saying that they're going to achieve $20 billion of free cash flow. If I divide it by the shares outstanding, that's $2.78, much, much higher than what I have. Now let's just see how this plays out, then we'll put in the higher number and see what we get. But they're telling me $20 billion of cash flow. They've really never generated it. I guess right prior to the deal they did, but they're spinning off division, so I can't count all the cash flow. But what I'm saying is I don't necessarily want to give them credit for the $20 billion. So I'm going to start with a lower number and we'll see where we get. If I grow that at 3%, I get $1.92 per share. I give a 7% free cash flow yield, which is the same yield that Verizon trades at as a comparable. I get a $27.47 long-term price target for AT&T based on a conservative 3% growth and the conservative historical free cash flow per share of roughly $1.47. All right, so now what we do, now we have an opinion on the stock. We know a free cash flow valuation, $27, an EBITDA market multiple valuation of $31. So we have 2 different valuation methods that came up with 2 different price targets. They have to be fairly close to each other. So I'm going to call it $27 long-term price target for AT&T as a pure play. Now we look in now we look at the stock market to see how much it trades for. So they're not biased when we create an opinion on a stock. You always want to do your valuation, come up with how much you're willing to pay for the stock, or what you think its value is out 10 years. Then look at the price in the market. If you look at the price in the market ahead of time, it's going to bias how you look at the stock. So come up with your own value, then look at the price. I can buy as much stock as I want right now for AT&T post-merger, $20 a share. If I toss this into an IRR calculator and I get the free cash flow per share here, I'm buying it for 20, I'm selling for 29, it's a 13% IRR business over the long term. If I put this into a distribution, so you can say, hey, 6 months from now what happened, where the stock is, what does this model produce? Well, $20, it's giving me 13%, which is a market-beating return, right? The S&P 500, 10% annually for a 10-year period of time on average. So this is forecasting a 13%, which is a 30% beat, not bad. If the price moves up, I'm not a buyer. But currently, I think that's an interesting price. If it falls, if it should fall again, I think it's a great, great buy. Let's go back and take a look at the number now if we change value for us. Okay, so now what I've done is I've adjusted the cash flow to be the $20 billion of free cash flow divided by the number of shares. Again, putting aside debt service for a second, and I'll continue the growth rate. But now if I take $20 billion and divide it by the 7.2 billion shares outstanding, I get $2.86 per share of free cash flow. That moves my price target up $53, which is a big move. Now, if I take that and let's just re-gear our financial model to just be purely based on the value of free cash flow, $53 a share. I put that into the model. I get higher free cash flow going forward. I buy it at 20, it's out at 53. That's a 26% IRR, which is a very, very huge beat, a monster beat. A very interesting upside case if they can achieve the $20 billion and grow it going forward. So what do we want to do for AT&T? Okay, we've talked through it. Let's figure out. It's got a low growth rate, 3%, low hurdle. They've adjusted the revenue. Let's recap our 5 key attributes. Number 1, top line revenue growth. They're saying it's growing. It grew historically. We'll check the box. EBITDA growth. Yeah, I think they can grow EBITDA. Strong free cash flow. The free cash flow is strong, and it gets even stronger if they get the $20 billion. Low debt. Debt's slightly higher. But I'm going to check the box because I think I'm putting in pension obligations and fully burdening, so I'll check the box that there's low debt. Well priced, yes, I think it's well priced. Both because if I use the average free cash flow per share, it's 13%. If I use the price estimate that they have, which is the $20 billion, it's a 26% IRR. That to me is a very strong upside, and I like that in an investment. So I'll re-gear this so it's just the 13%. So what we're going to do is we're going to give it a good. I think it's a good investment. They're going to be paying a strong dividend. It's currently yielding 5.7%. And I think it's a good long-term investment for someone who just wants kind of a conservative, the original subscription model-based business. That's the review of AT&T. I want to take a moment here to say, if you haven't done so and visited the website, cashflowinvestingpro.com, I teach a course that teaches you how to do this for yourself. And I want to tell you, if you did this for your investments over your lifetime, they would be remarkably different in your understanding of cash flow and the businesses you tend to back with your hard-earned money. It's the best passive income strategy you can possibly make, is simply being a more prudent investor and buying cash flow. Check out the website, cashflowinvestingpro.com. I teach a course where I give you this Excel sheet. We walk through Apple as a valuation. I teach you how to read 10Ks, how to pull revenue, EBITDA, how to calculate debt, how to build a forecast, what market multiples mean, what yields mean. And you can create a forecast for the businesses that you want to buy, put that away, and that is your template. You do not need to rely on the talking heads out there in the world who are so focused quarter to quarter, they miss the big picture. And looking at 10 years of financial really gives you a crystal clear vision. Definitely check out that. You can also join the Cash Flow Club, where I publish one-pagers and stocks that I review in a kind of blog format as I'm going through. I do more stocks in there, roughly a dozen every month, that I can review, many more than I can do videos for. So check that out. You can also download a free one-pager on Twitter and some other stocks that I have reviewed on the website, cashflowinvestingpro.com. Again, thank you for looking at the stock review of AT&T. I'm going to follow this up with Time Warner here shortly. It's kind of a duo of the two, figure out which one is better to buy, if any. Throw me a comment down below if you like the stock, if you like the analysis, if you like that upside as well. Up are going to pop a couple other videos for some relative value investing if you'd like to see other videos. Thanks again for watching the channel. I greatly appreciate the support. Don't forget to hit this like button, and I'll see you in the next video. Take care. Bye-bye.